Hi friends, welcome to this new episode of my podcast, A Digital Tomorrow. Today I'm joined by Dan Liebau. Dan describes himself as a 50% practitioner and 50% academic, and not without reason. From the practitioner side, he founded Lightbulb Capital in Hong Kong in 2014, now being based between Singapore and Hong Kong. And on the academic side, he's involved in teaching many courses, in writing lots of articles, as he's going to let you know right now. So without further ado, welcome Dan to my podcast.
Mario, thank you so much for having me today. We've been planning for this for a while, so I'm really looking forward to the conversation.
Me too. It's going to be a great conversation, I'm sure of that. So I think we should start by talking about this academic side that I mentioned before. I know that you've been teaching several courses at SMU, Singapore Management University, and now you launched some new courses on DeFi. So could you please tell our listeners a bit more about these courses, and also about the idea of educating in DeFi? Because based on my experience, I think that compared to traditional finance, there is to some extent a lack of education in DeFi and also in fintech in general. So aside from talking about your course, if you could also as well let me know whether you think there is this gap or not.
Yeah. Maybe I'll start with education in fintech, just for a little bit of context. So in 2016, I basically launched the first fintech course for executives in the Asia Pacific region, simply because I was of the same opinion as you, that there is not much opportunity for people who work in financial services today to learn about these sort of new emerging technologies, but also approaches on how to do innovation, if you like, whether that is related to design thinking or business model innovation and so on. So from then onwards, basically, I have had the chance to partner with several universities around the globe to teach and do guest lectures and also run full-day classes, two-day classes in all sorts of related topics to fintech and later also blockchain. And the latest course on decentralized finance really came about because I had the opportunity to read an early draft and contribute a little bit to a book by Cam Harvey and his co-authors, who is obviously very well known in the world of traditional finance. And they did such a great job in basically describing what DeFi is and how it works. So there's a lot of influence in my class from that book, and that's why I also give every participant a copy of that book, because I think it just summarizes what DeFi is and how it works. So basically the way we structure it is to say, okay, we'll look at the origins of DeFi first, is a little bit of a background. And then we look at the different kind of DeFi infrastructure components, right? Whether that is, that's where we're basically building up the language to discuss DeFi matters. So we talk about things like smart contracts and what decentralized applications are and oracles and stable coins and so on. And then we move on and we basically discuss what we call DeFi primitives. So that's all your different token types, right? Whether they're fungible tokens, non-fungible tokens. What does staking mean? What does slashing mean? What are token swaps? And what's a flash loan and how all of that sort of thing works. And then basically we discuss a little bit, what are the problems that DeFi could potentially resolve in the future? Yeah, right now is a very nascent space. We all know that. And there's a lot of tension between perhaps traditional regulators and then all of the entrepreneurs that are creating these new platforms. But DeFi is there for a reason, or for 5 reasons, basically to resolve for inefficiency or limited access, also opacity of the financial system, and then also centralized control and lack of interoperability between different parts of the financial ecosystem. And I guess what has attracted a lot of attention, especially from regulators, is the last part of the class where we discuss the risks. Yeah, because while there's so much opportunity, we cannot shy away from discussing what needs to be carefully managed. And compared to traditional finance, the risk types are quite different. Yeah? So we discussed things like, for example, smart contract risk, governance risk, oracle risk, also scaling risk, and then risks associated to interacting with decentralized exchanges, impermanent loss, and so on. And then also what the sort of regulatory requirements could be for these platforms in the future. And that's why recently we've got like a rather big inquiry from a regional regulator that says, okay, we want our officers to learn about all of this, because eventually we will have to wrap our head around how this new type of finance works. Yeah? And that's, I guess, another contribution to your first sort of question about what do we do with helping people in the ecosystem to understand, is basically getting a foundational understanding of all of these topics, and then enable people to research and investigate more, right? Because in a 2-day class, you can only do so much.
I fully agree. I fully agree. I think your approach is actually very, very interesting. And I also like the idea that you talk about risks, because, well, I know that when some people talk about DeFi, they just focus on the opportunities, which are many, but at the same time, there are some risks that you need to bear in mind. So I like this approach. Yes. And of course, I good luck with your course. Related to that,
it's just before we wrap up, I mean, one little thing that I want to throw in here is one of my first slides in the class has a picture of a very large green candle and one of an engine, right? And basically the message of this slide is, I'm not going to talk about the green candles too much. I'm going to talk more about the mechanics of DeFi and how, you know, the methods work, rather than where to find a very high APY, because that's might be sustainable or not, but it's much more important from an educational point of view to understand the mechanics.
I fully agree. I fully agree. I concur. And well, now that you talked so much about DeFi, I wanted to ask you, what's the future of DeFi according to you? Because you said before, and you are very right, that DeFi is still a very new initial industry. So yeah, how do you see its future?
Yeah, I don't have a crystal ball, but I can basically, if you think about blockchain ecosystems, then they are platforms that allow two parties that want to, you know, engage in an economic transaction. They allow them to do it without having to rely on the rule of law. Because basically there's a clever incentive mechanism that makes sure that everyone behaves and delivers on what they kind of commit into a smart contract, or they are part of the transaction. And that's very different from how our traditional world works, right? Because if, for example, you and I engage in a transaction and then I run away with money, then you know my name and you can find my address and you can go to court. And then you report me to Hong Kong police, and then I have a problem. So where these two worlds collide, right? This world of incentive mechanisms and this world that is basically run by rule of law, there's always tension. Yeah. So it's not unexpected that regulators and the traditional financial services world struggles to wrap their head around a concept where there's basically that is basically designed without having rule of law in the back of our minds. No? So that's why I say I can't really tell you where it's going. But one important thing that I want to kind of highlight is that I've worked in financial services since 1999. So that's kind of the only industry that I've ever worked in. And a lot of it was spent in technology. And so I was always curious about, efficiency gains and how to do things better and create new systems and so on. And what I have to say is that since then, unfortunately, all the improvements were rather incremental. Over 20 years, it's like tweak a little bit here, tweak a little bit there. I might have had a very different perspective when I was still working in one of these large banks that would probably change the world today, but actually it's all incremental. So the first time I ever got to see a real sort of piece of technology that could have meaningful and big and almost, people, it's a bit overused, but I'll still say it, disruptive kind of character of a technology is really decentralized finance, because the cost income ratio that is so high in financial services companies today can basically be reduced to a few lines of code in a smart contract. Yeah. Of course, I'm simplifying and I'm glossing over a few things. There's a lot of complexity in traditional finance. I understand that. But the key building blocks to create finance without these very large institutions has been created. And that's kind of what I find quite fascinating.
Mm-hmm. Thank you. Thank you for sharing. And well, now that you mentioned blockchain, I want to talk about a very relevant topic according to, well, I mean, to many people, no? I mean, to me, to you, which is blockchain and sustainability. We all know that, all the industries in the world are trying to be right now as sustainable as possible. And we all know that, blockchain and especially cryptocurrencies, and more especially crypto mining, have, become kind of an issue because of its large carbon footprint, therefore because of its lack of sustainability to some extent. So do you think it's possible to come up with a sustainable approach to blockchain and cryptocurrencies? And if so, what might that strategy, that approach look like?
Yeah, that's a good question. And yeah, obviously we agreed this one beforehand because I wanted to talk a little bit about the recent work that I did together with Modular Asset Management, which is a fund management company in Singapore. And the idea was really to investigate a little bit whether, sustainability or ESG or however you want to call it, fits together with the concept of a blockchain. And I kind of want to start with a nice quote by Professor Ari Yultz, who just recently testified in front of the US Senate, right? And one of the key sentences that he basically wrote down in his testimony is, crypto doesn't equal Bitcoin. Yeah? So we shall not try to kind of throw everything into one basket here, and a more differentiated approach is definitely of value. The work that we have done between Lightbulb Capital and Modular Asset Management is really to develop a sustainable investment strategy that focuses on smart contract platforms. So not all types of different tokens that are out there. As you know, there are basically payment tokens similar to Bitcoin, Litecoin, and so on. Then there are what people call the layer 1 blockchains, which are basically the operating systems of sorts, or basically, the economic kind of realms, if you like, for people to interact on. So that's what we've been assessing. And then based on that, there are also decentralized applications, right? Run by entrepreneurs that basically build different products and services on top of these smart contract platforms. So whatever I'm going to say next is basically very much focused on smart contract platforms that are, if I think about it, is probably like the Microsoft of the decentralized world, right? It's the operating system. It's the rules of how people can engage with each other. So I feel like the E in the environmental bit has been discussed enough already. So I don't want to spend much time on it, especially for these smart contract platforms. There is now research that suggests that proof of stake consensus algorithms are secure enough if configured correctly. So that's quite encouraging. And that means that basically the bulk of the issue goes away, because proof of stake is orders of magnitude more energy efficient than proof of work. I don't want to really talk about whether these smart contract platforms can replace the fiat money system, because that's kind of a different scope, and I want to stay away from that. But let's talk a little bit about S and G, because I feel that's where there's a lot of interesting stuff happening, but then people kind of haven't really discussed it so much. So in the social kind of bucket, we like to look at two things. The first is, what does the wealth distribution of tokens in one of these ecosystems looks like, right? And this is also a good moment to say that we are interested in picking, in this investment strategy, the sustainable platforms, also because we want to do the right thing, but also because we think there's a link between doing things in a sustainable way and long-term profit opportunity, of course. So the wider token distribution a platform has, the more people have an incentive to build something on that particular platform. And that should translate in more decentralized applications on top of smart contract platforms. And that in turn means more transactions, which makes the ecosystem grow and the token price of the layer one platform hopefully rise. So there's this interesting link. You're doing the right thing, but then it also has a direct impact. So that's one. We're also looking at building a framework that helps us understand what decentralized applications are being built on this platform. And I'll try to give a bit provocative and example. If you have a platform that only hosts decentralized applications that are supporting vices, right? Gambling and all sorts of other things that we know are not very good for humans. Maybe we like that less than if there's a platform that can, because of its design characteristics, support financial inclusion, for example, right? Because the transaction is relatively cheap compared to some major platforms that we see today. So that's kind of the S bucket. The G bucket, governance, is also very interesting. We're very concerned with miner or validator collusion risk. So we don't like when there are only very few miners and they're very likely to be controlled by the same entities. Basically, if miners or validators can get on a Zoom call to agree something, then the number is too low. So we like it to be higher. We also like platforms to be designed, or consensus algorithms to be designed in a way that practices like, for example, miner extractable value are less likely to happen. And maybe you cannot extinguish this and rule it out 100%, but there are design characteristics that make miner extractable value easier than in other cases. So these are also things that we are looking at. And then, of course, voting plays an important role. And I guess we're far away from saying that voting and governance mechanisms associated to voting are very mature and well thought through. They're not. But that's why we look at people's trajectory, right? And how do they develop and continue to improve platforms over time? So that's another thing. So, to sum it all up, it's very likely that those platforms that are more sustainable, as the word suggests, are going to be around for longer. And then those are the ones that probably Modular Asset Management also wants to have in their portfolio at some point in time.
I see. No, I find your approach very interesting, and I also liked very much what you said before about that quote to the US Senate, the idea that crypto doesn't equal Bitcoin. And I would say more. I would say that crypto doesn't equal blockchain, because before we talked about sustainability in blockchain, and whenever you hear or read news about blockchain, people tend to automatically think blockchain, cryptocurrencies, but blockchain is much more than just cryptos. So I think I think it's the right approach, and I think in general we need to work towards a much more sustainable world. So any area where we work to make it improve is welcome.
Yeah, actually, if I may chip in, I slightly disagree with you, and I've been called out on this many times, but I'm just going to say it again. This whole idea of blockchain does not equal cryptocurrency, I'm not sure whether I buy into that, because if you think about it, right, then the main value proposition of blockchain technology is for two or more individuals to transact trustlessly. Yeah? And for that, you basically need the incentive mechanism that we have discussed before, yeah, to incentivize good behavior and punish bad behavior. And that requires a token. So to me, any platform that is basically not a public blockchain, I kind of struggle to see a little bit the value, because you could arguably maintain a centralized ledger if you are aware of who the market participants or the economic agents are, right? So I'm sometimes not so sure whether I agree with this whole blockchain does not equal cryptocurrency. To me, it very much means that, right? A blockchain is basically a public blockchain, and private blockchains might offer some inefficiency solutions, yeah, sometimes. But I also find that people who go for private or permissioned blockchain systems are mostly rather conservative, large companies. And their approach, of course, exceptions confirm the rule, but their approach often suggests that they want to own the ecosystem. Yeah, they will say, "Hey, we don't like crypto, but we like the technology behind it, and we want to implement blockchain, but it better be our blockchain." And that's kind of the opposing end of what crypto and blockchain actually stands for, which is an open system. Anyone can join, anyone can leave anytime. Yeah? So I think there is a bit of a analog signal that these type of companies send into a digital world that now arguably runs on a little bit of a different type of rails.
Well, I mean, I think we cannot deny that blockchain was created specifically to support cryptos and more specifically to support Bitcoin, sorry. I mean, that's undeniable. But I think that at the same time, to me, the technology has evolved to a point that, at least to me, I mean, I agree with your approach, but I think that blockchain is much more than cryptos. I know that the best use case for blockchain, the best or maybe the most accurate one, if we stick to the essence of why it was created, remains cryptocurrencies. That's undeniable. But I also see many use cases for blockchain as a technology behind cryptos when it comes, for example, to banking and many other areas, even healthcare, gaming. I know that that's not maybe why blockchain was invented, but I see a good use case in there anyway. And I know that, private blockchains versus public ones, this is a very hot topic. There's a lot of debate going on. I know that, and I also know, for example, China created its blockchain-based service network, which some people find amazing. I actually interviewed its creator, Fan He, in some of my previous episodes of my podcast. And while some other people think that these kind of networks are contrary to the essence of why blockchain was invented. So I know that's a debate, but at the same time, I feel like this essence of what blockchain initially was, of what cryptocurrencies were, to some point, they're going to be missed somewhere as well. The more we start regulating this industry, the more we start regulating this market. I mean, it used to be the Wild West. There were no regulations. We saw all those huge crypto exchanges growing and expanding worldwide without any kind of regulations. But now this is changing. So the more countries start to regulate this area, and I mean, let's face it, at least to me, it needs to be regulated. The more, to some extent, some people might say that the original essence or idea of cryptocurrencies might be lost, because either by making a blockchain private, or either by regulating this industry much more than before, to some extent, either big companies, as you said, or countries are kind of centralizing this, not completely, but.
Well, I think it's perhaps we are all right. I think it's perhaps not either or. And what I would argue is that at the minute, the crypto ecosystem is hyper financialized, if that's even a word. The level of financialization is super high. And if you look at like history, that's not a very good thing to happen. So what I'm actually quite keen for is to see sort of real use cases where these smart contract platforms can be utilized to solve somebody's problem, right? And that's why in that investment strategy with Modular, it's also a sort of longer term approach to investing where you hold a number of assets rather than trading in and out all day long to kind of tease out some sort of market inefficiencies. Yeah, there are many, I think there are many investment managers that very much engage with extracting inefficiencies from this rather nascent market. I think where our strategy is quite different is really a long-term bet on the adoption of these smart contract platforms. Yeah? And of course, then we look at very different things and we try to understand, you know, do these platforms offer some sort of interoperability type of capability, right? Between each other, but also between perhaps, let's call them legacy companies, right? That have real interactions and businesses with humans all around the world. And I think these are sort of more fundamental ways of looking at it. And I don't think that this is going to go away. Yeah? And you might even see that the application of these smart contract platforms and then economic activity on top of it is something that it becomes part of day-to-day life. And the focus basically shifts from trading tokens in and out, which is what's happening right now, more to, okay, you know, I'm building this application and then I need a balance because I basically need to pay my little tax to the ecosystem to make this service available to my users. So I think that's kind of where we're headed a little bit in the medium and long term. Mm-hmm. What that means is that the correlations between different cryptocurrency tokens will also break apart. Yeah, and what we're saying is basically the not so sustainable ones will go a very different route from the sustainable ones. If sustainable means, you know, they can remain in the top 20 on CoinMarketCap for very long, then those are really the winners based on kind of these sustainability characteristics that we're trying to assess today.
Mm-hmm. No, I think it's very important what you do. I fully agree with you. And then, following what we discussed before about like private versus public blockchains and regulations, there is, to me at least, this dichotomy. I mean, we saw this last year cryptocurrencies becoming much more mainstream, which is, I guess, I mean, it's good overall. We saw many incumbents, big institutional players tapping into this market and making the whole area of DeFi become much more mainstream in every possible way. But at the same time, this also makes me wonder whether, to some extent, at least for those who started like with DeFi like many years ago, this industry is not kind of losing its purpose. I mean, my point being, if people started to trade cryptos as an alternative way to finance, but now we are seeing that the most interested in cryptocurrencies are precisely, the very same big banks or asset managers from whom maybe these people try to escape. I don't know that's the right word, but let me put it this way. Aren't like we like assisting maybe to like a complete reshape of this DeFi world? If DeFi becomes much more institutional, you get my idea what I mean, no?
Yeah, I mean, again, no crystal ball, but let's just look at a few facts. Yeah. So the first fact is that most of the inventors of DeFi platforms are probably quite young, yeah, below 30. The ones that really created very, very large platforms like, let's say, Uniswap or something like that. Mm-hmm. And they didn't come from a finance background. And I guess that's part of the reason why they invented mechanisms that have nothing to do with how traditional markets work. And I'm not necessarily saying that that is always a good thing. I mean, there's already now a new research paper by Caponi and his co-authors that basically suggest that liquidity provision on decentralized exchanges is not an economically viable activity unless you have some sort of emotional attachment to the platform, right? But I think that's kind of one thing. The second thing is, yes, we are in this kind of period where there's hyper-financialization of tokens, but I also anticipate that will not continue forever. And, you know, now the market is a bit softer. Some people have already lost their shirt, they will lose interest. And then what I hope is that there's a bit of a wash out, and then people who just were in for the very quick money might eventually not be there. And then we can really focus on kind of creating things that make a lot of sense and help people with whatever problems that they have. Yeah? And perhaps particularly in DeFi, I want to talk about borrowing and lending really quickly, because it really triggered this aha moment in my own kind of in my own life. And that was when I first deposited some cryptocurrency into a smart contract to get a stable coin loan, which I then wired to an exchange that could exchange this stable coin for fiat money that ended up in my Citibank account, and that I could then spend in a restaurant to buy a pizza or something, right? It made DeFi proposition to me really real, because you could see that there's suddenly a link where you knew the pizza is financed. I mean, please don't buy pizza on loan, huh? But you know what I mean? There's a link between this ecosystem that often is perceived to be as this virtual reality casino kind of a situation to something that is actually quite real. Yeah. And of course, there's frictional cost that is relatively high, but again, it's early and these things will eventually be sorted out. And if some of the crypto wealth in the world can be used to borrow against and to, you know, help micro entrepreneurs to get on with their business and manage their risks, that's fantastic. Yeah, but of course, big caveat, lots of issues, teething problems, and so on. But I think the basic building blocks of doing finance in a very different fashion that is not dominated by the sort of same characters that we have known for many years now is actually possible. And let's see how it all develops from here.
No, I think your thoughts are actually spot on. I fully agree with you. It's a very real world. And I actually always encourage people who are a bit reluctant towards this idea of DeFi to do what you did and what many other people do, to try to get some cryptos, trade them, and then try to convert them maybe into fiat currency to eventually realize that thing that seems so ethereal and maybe unreal to some because you don't know where it is, if you are not like an expert in this area. And I know that for the layman it may look like that's a bit of I don't know, some people find it a game or gambling. Then you realize that that's actually, it has a financial value, there is a proposition behind that. That's not just like a game. And I think people need to experience that by themselves, because just by reading the news and reading that this person made that money by trading this or trading that, you don't actually get to get an actual glimpse of what's going on in there. You need to actually join an exchange or start doing that by yourself, even if you don't want to trade like on a regular basis or professionally or anything like that. I think that it's important for people right now to get some kind of idea of what DeFi is, even if they just do it once in their lives. I think it's going to be important to them.
Yeah, no, that makes a lot of sense.
And well, unfortunately, we are running out of time. We wanted to discuss some other topics as well, like decentralized exchanges and governance and many other areas, but I guess we'll need to leave it for the next episode, for the next time that we meet, which I hope will be soon done. And well, I would like to thank you for your time, for this great discussion. Thank you very much for coming.
No, my pleasure to have a chat with you today, and then I hope to see you again soon.
Thank you very much. And well, to all my listeners, thank you very much for listening to this episode, and please stay tuned for the next ones. Bye all.